Have you ever realized that sometimes what you actually earn in investing is less than what you see in your account? And wondered where the rest went? I still remember the first time I noticed a chunk missing from my small gains and thought, did I do something wrong? Turns out, it was taxes and fees quietly sneaking in. If someone had taught me this earlier, it would have saved me years of slow growth and unexpected costs. Before we dive in, take a moment to subscribe to this channel. When you're part of our global community, you get new episodes, Q&A sessions, and practical tips that help you hold on to more of your hard-earned money wherever you are in the world. Plus, when you subscribe, you'll have a support system that turns confusing topics like taxes and fees into clear, easy wins. Take about 10 seconds now, hit that button, and get ready to make every investment count. Okay, let's get real about taxes and fees. They're often overlooked, but they can make a huge difference in growing your wealth. Every country has its own rules, but the principles are the same. Taxes are what governments collect as a share of your earnings, and fees are what brokers, platforms, or funds charge for their services. Here's a simple but realistic demo example. Meet Rohan. He's investing $200 a month into a global index fund. The fund has an expense ratio fee of 1% yearly, and his country charges a 10% capital gains tax when he withdraws profits. At first glance, he expects his investments to grow at 7% annually, but after fees and taxes, what he really keeps is closer to 5.3%. That difference could mean thousands lost if he doesn't pay attention. Even small fees, like the expense ratio, start to compound against you. Paying 0.5% less, moving from 1% to 0.5%, can mean you keep thousands more over 20 years. And by knowing when and how gains are taxed, like long-term versus short-term, or via automatic fund reinvestments, you can plan smarter and avoid heavy surprises later. Let's make it actionable. Here are the steps every investor should take. Check all fees before investing. Look at expense ratios, trading commissions, account maintenance, and even withdrawal fees. Many beginner-friendly platforms now offer zero commission trades, but always check for hidden costs. If you're choosing mutual funds or ETFs, compare their expense ratios. A difference of just 0.5% may not seem like much, but over decades, it can be a huge hit to your returns. Prefer low-cost options where possible. Learn about your country's tax rules for investments. In the USA, long-term capital gains over 1 year are taxed at lower rates than short-term. In India, long-term equity gains over 1 lakh are taxed at 10%, while short-term are at 15%. Most countries reward patient, long-term investing with lower taxes. Consider tax-advantaged accounts where available, like Roth IRAs, 401ks, stocks and shares, ISA, NPS, or PPF. These let you keep more of your gains, often with tax-free growth or deferred taxes. Track every deduction. If you pay fees, commissions, or even lose money on an investment, save those records. In a lot of places, these can offset your taxable gains and lower what you owe. Everyone's situation is unique depending on where they live and how they invest. Don't be afraid to ask your broker, bank, or a tax professional. No question is too small when it comes to keeping more of what you earn. Here's a phrase I remind myself often: small leaks sink big ships. When you know exactly how taxes and fees work, you plug those leaks and speed up your financial journey. Next episode, we'll talk about how to review your investments, adapt as life changes, and keep growing, because learning never stops in investing. If you found this episode valuable, give it a thumbs up, share your experience, and ask any questions in the comments. Your story could help someone in another part of the world. And if you haven't yet, subscribe now to join a global movement of smarter, more confident investors. Let's keep building a wealthier future, one informed decision at a time.